Hey guys, what's up? Welcome back to another video. In this video, I'm going to talk about a stock that recently announced earnings for the second quarter of 2023, and that stock is 3M. And as you can see, over the last year, 3M is not doing good at all. They're down 20%, underperforming the market's 12% return. So in this video, I'm going to look into some of the recent news that came out surrounding 3M. I'm going to look at their financial statements, and then I'm going to use a discounted cash flow model, and I'm also going to use the weighted average cost of capital for 3M to figure out the intrinsic value per share for their company. So right here in this article, it's titled Why 3M Stock Was Climbing Today. It was released when they released their earnings report. Some key points they touch on include the fact that 3M topped estimates on their revenue and their net income, and the company also took a $10.3 billion charge for a litigation that they've had. So right here, they point out that 3M moved higher as the conglomerate topped low expectations in their second quarter earnings report and also put a multi-billion-dollar lawsuit behind them. Right here, they point out that the slowdown in the economy has really been a struggle for 3M. Earlier in the year, 3M implemented layoffs, a restructuring for their business, and also other cost-cutting measures to downsize their business as revenue declined. Sales continued to fall in the second quarter. Overall revenue was down 4.3% to $8.3 billion, but that was ahead of analysts' consensus for $7.87 billion they expected. They point out right here that 3M had a litigation that was pending, and they recently settled it for $10.3 billion in pre-tax dollars. And it was a litigation that they had with public water services around the country because of their forever chemicals, which were found to be environmental hazards. But despite the large price tag, investors were actually pretty happy to see that the company was done with the matter. They point out right here that in regards to litigation, 3M will be making $12.5 billion in payments over 13 years as a result of the settlement. So some interesting news coming out surrounding 3M. This article is obviously pretty optimistic, saying that it's a good thing that they're past the litigation and they're just going to settle on a charge. And although their revenue has declined, it didn't decline as much as analysts expected. But this article takes a different perspective, more of a bearish viewpoint. We can see some key points right here that I'll cover. Right here, they point out that 3M's gross margin continued to deteriorate, raising questions about the company's economic moat and pricing power. They have high inventory levels, deteriorating asset turnover, stagnating cash conversion cycle, which underscore a lot of 3M's operational challenges. The combination of legal headwinds along with operational efficiencies and a poor balance sheet do not warrant a long position in 3M. And although their dividend, which I'll cover a little bit later in this video, is actually a pretty good dividend, appears to be safe on the surface, a rebasement to prioritize deleveraging cannot be ruled out. Also, in view of the upcoming recurring legal charges, as the last article pointed out, they'll be paying a little over $13 billion over the next 13 years. So definitely pretty interesting. This article has more of a bearish viewpoint on the same exact points that the last article covered. So it'll be interesting to see in the future which one of these viewpoints, the bullish or the bearish perspective, ends up prevailing. But right here, we can see their financial statements for their 10Q report. Net sales are down year over year from 8.7 billion to 8.3 billion. So that's a decrease of 4.3%. And unfortunately, we can see right here, selling, general, and administrative expenses increased a whopping 306% from $3 billion in 2022 to $12.2 billion in 2023. That pushed their operating income in 2022 of $110 million down to an operating loss of $8.9 billion in the second quarter of 2023. Lastly, for their bottom line net income, we can see right here, that's a decrease from $78 million to a net loss of $6.8 billion. So that's a decrease in net income of 8,818%. So really not good news for 3M's bottom line here. Then we can see right here on page 5, their balance sheet. Total assets are up from $46 billion to $48 billion. And then we can also see that total equity was pretty much slashed in half from $14 billion to $7.8 billion. Retained earnings also decreased from $47 billion to $40 billion, not a good sign. And we can see total liabilities increased from $31 billion to $41 billion. So really not a healthy balance sheet, as the recent article pointed out. Then lastly, right here for their cash flow statement, comparing the first half of 2022 to 2023, operating cash flow increased from 2.1 billion to 2.7 billion. And then we can see from their financing activities, so far year to date, they've paid around $1.6 billion worth of dividends to shareholders, which is around the same 1.7 billion in the first half of 2022. So they are prioritizing returning value back to shareholders just as much this year as they were last year, which doesn't really make much sense if you think about it, because they had a lot more cash last year. So if they're still returning the same amount of cash to shareholders, it could mean that they are running out of leeway to continue to be able to support that strong dividend in the future if they aren't able to turn their cash flows around and their earnings around. So right here, this is a discounted cash flow model to figure out the intrinsic value per share for 3M. Right here, we can see the growth rate I'm using is negative 4.6%. And I got this growth rate from this historic growth rate calculation table right here. Beginning free cash flow, their free cash flow in 2018 was $4.86 billion. And in 2022, their free cash flow was $3.8 billion. So that was a decline over the course of 5 years, which comes out to a compounded annual growth rate of negative 4.6%. So that's where I got this growth rate metric from, and that's what I'm going to use for this discounted cash flow model. Weighted average cost of capital came out to be 4.88%, which I'm using to find the discount rate to discount 3M's cash flows to the present value. I got that from the weighted average cost of capital calculation right here. We can see I had to calculate their cost of equity, which I use by just taking the risk-free return, the 10-year treasury yield of 3.91%, which is where it's at right now, added 3M's beta, which is 0.95, multiplied that by the average market return of 10% minus the risk-free return, and that gave me their cost of equity 9.7%. We can see up here their cost of debt is around 2.91% interest rate. Right here, we can see equity proportion, debt proportion. Their balance sheet was split mainly with liabilities and less on equity. They have around 31% equity, 68% debt. So that puts their weighted average cost of all of their capital at 4.88%. I basically just multiplied, as you can see from the equation up here, I multiplied their equity proportion by their cost of equity, added that to their debt proportion multiplied by their cost of debt, and then multiplied the debt proportion by the tax shield, which is 1 minus their tax rate, their effective tax rate in their most recent full year of 9.6%. That gave me the weighted average cost of capital of 4.88, which is what I used in this discounted cash flow model. Terminal value 10, their free cash flow in the most recent full year was 3.84 billion. They have a net debt position of 12 or a little under $13 billion of debt on their balance sheet, and they currently have 550 million shares outstanding. That puts their intrinsic value per share at $54 per share, which means that at the current share price, they are not trading below intrinsic value per share. You'd want to buy them at an even cheaper price than their current share price, which is really not a good sign because obviously 3M is struggling right now. So it's not like you'd be buying into a company that's necessarily on the trajectory to grow. So this is really not that good news. Also considering they have a negative growth rate up here and a net debt position on their balance sheet. Right here, I did a competitor/industry analysis comparing 3M to some other conglomerate companies, GE and Accenture. We can see that in comparison, 3M has these are their profit margins for the most recent full year, 2022. As you can see, obviously, more recently, they've been struggling with profitability. So these profit margins might be a little bit outdated, but I am comparing them to the other profit margins for the companies for their most recent full year as well. We can see that in 2022, 3M had a higher gross profit margin than GE and Accenture. They had a higher net profit margin, and they had the second highest return on assets. Accenture had the highest at 15%. PE ratio current is obviously not applicable for 3M because they are not profitable at the moment. And then we can see, as the article touched on earlier, 3M has a really strong dividend of $5.96 per share, or a 4.97% dividend yield. So basically, for every $100 you invest into 3M, you're getting paid a dividend of around $5 per year, which sounds nice on the surface, but obviously the $100 that you invest into 3M, if it's declining by this much year to year or more, then the dividend might not end up being worth it in the end. And to end off the video, I wanted to compare 3M to some of the other companies we've looked at in our past videos. In terms of intrinsic value per share, 3M's current share price is around $112. Their estimated intrinsic value was $54. That means they're currently trading at around 2 times their intrinsic value per share. That puts them in 10th place on the intrinsic value table. So far, Google, Alibaba, GE, and Etsy are the only companies we've looked at that are trading below intrinsic value per share. We can see right here for growth rate, 3M had a negative growth rate, so they aren't able to make it onto the growth rate table. For dividend yield, 3M shoots to the top of the table with a 5% dividend yield, higher than all of the other companies we've looked at since we added the dividend yield table. For profitability, 3M had in their most recent full year a 43% gross profit margin and a 16% net profit margin. Neither one of those is good enough to get them onto the table. Adobe had the highest at 86% gross profit, and Oxy had the highest at 36% net profit. For companies ranked based on Q2 year-over-year revenue and earnings growth, we saw that 3M had negative revenue and earnings growth, not good enough to get them onto either table. Tesla had the highest Q2 year-over-year growth at 47% revenue, and then Kura Sushi had the highest earnings growth for the second quarter at 240%. Then lastly, for stock performance over the last 5 years, 3M didn't make it onto this table as well. They're currently down 46% over the last 5 years. So that's definitely not good enough to get them onto the table. Obviously, Tesla has the number one spot at 1,144% return over the last 5 years. So based on this, they're really not that competitive in terms of comparing them to the other companies we've looked at, except for in dividend yield. They do have the highest dividend yield out of any company we've looked at. But as I touched on before, that might not be worth it if you're investing into 3M for the dividend, because the value of your shares are going to decline so much because of their share price decline. We can see right here in terms of comparing them to the other companies that are also similar to conglomerates, that they were doing pretty well in 2022, but it'll be interesting to see how that ends up in 2023. And then for their discounted cash flow model, they are currently not trading below intrinsic value per share. So let me know in the comment section down below what you guys think of 3M. Leave a like on this video, subscribe to the channel, and I will see everyone in the next one.